Hey, welcome in. It's Ken Angst here. Hey, today, if you are a move-up buyer, you are going to want to listen to this podcast. So today we have one of our favorite lenders in town that we use quite a bit, talking about how to move up if you are in one of those circumstances that are fortunate enough to have lots of equity in your home and are looking to move up in Reno. So we have Brian Cushing here. How's it going, Brian?
It's going great.
He's with the Cushing team with Guild Mortgage, one of our preferred lenders, very knowledgeable about all topics related to mortgage. And what we're going to do today is specifically talk about move-up buyers. So, Happy New Year.
Yeah. Well,
so, any New Year's resolutions?
Well, no, because the first month, I think everybody quits their New Year's resolution and the month's almost over.
Yeah, so you've already given up on that. That's smart. That's actually good advice. I always have New Year's resolutions that I never make it through. So. By the way, if you are watching this live on Facebook, feel free to send us messages. We're becoming more high-tech here, and on several of our podcasts now, we are actually seeing people type questions in, and if you have questions, feel free. We can answer them live. So let's get going. First, I want to talk about, obviously, the 6 strategies to move up. So obviously, the first one you want to do is hire a good realtor, hopefully the Angst team. But if you have another realtor, you want to hire someone that's really knowledgeable and first establish the value of your primary residence. Do you have any comments on that?
Well, yeah, I mean,
that kind of sets the basis,
it
right?
totally sets like the stage for what you're going to do. Like, what do you have in equity? Not what the website says, but what does the real estate professional that knows the market have to say?
Right, because a lot of people look at Zillow, and there's nothing in Zillow, but just make sure you have someone come in and look at real comps, because looking at comps that are any more than 30 to 60 days old is not going to do you any favors, because the market is changing quite a bit here. And that reminds me, talk about interest rates right now. What are they, and how's it going to impact a move-up buyer?
Well, interest rates are up. I mean, compared to the all-time low. So all-time lows from 2020 in the pandemic era, in the endemic era, I think that's what they're calling it now. Rates are going to go up, and they're basically back to 2019 levels, which were already pretty good. I mean, you're like 3.6%, somewhere in that range.
Okay.
And higher if you have a low credit score. Lower if you're going to do like a 15-year fix or something like that. But I think the strategy around like how to acquire the next house, that's the whole point in getting your equity figured out. And then how you're going to use your equity. Are you going to keep that house and keep the equity where it is? Or are you going to leverage that equity? Or are you going to sell, right? So I think we're going to all those things to talk about.
First, figure out the value of your home, subtract closing costs for realtors and title costs, and then minus your mortgage value. So that's going to give you how much money you have to play with to afford this brand new move-up house.
Cool.
So second, once you do that, then it's time to have a little fun, and we like this. I know a lot. And start looking at neighborhoods. Have your realtor go view neighborhoods, and maybe you're not quite ready, but it's a good time to establish what neighborhood you want to live in, and then start figuring out what you can afford. And once you figure out what kind of neighborhood you have, the value of your home, then it's time to talk to Brian.
Well, the size of the house might matter too, right, Ken?
Right. That's right. Obviously.
Well, maybe I'm assuming you're going to go to a bigger house if you're moving up, but you might just be moving across town, and it's just a more expensive area with the same number of bedrooms.
Right.
So
obviously you got to establish what you want in the house, and if you need another room for a home office, that's a lot when we get in for 4-car garage or something like that. Obviously, establish all that up front. So then you know the approximate value of your home and minus all your fees, and then you have the amount that you want to go purchase on the new home and establish that. Then it's time to talk to Brian. So what we'll do is have you go over to Brian, and then he'll establish and get a pre-approval letter, because right now in the market, if you can't obviously make offers on any house unless you're fully pre-approved.
Unless you're cash.
Unless you're cash. So that's a good question.
You don't need me if you're cash.
That's right. Very few people can afford to do that. So next step is obviously talk to Brian and make sure that, everyone has dreams, but make sure it's reality. Qualify, talk to him about what you can sell it for, and then figure out what in reality you can afford. Do you have any comments on that?
Well, yeah, I mean, we talked about the value, right? So then how you're going to convert the value from the equity into the equity of your next home. So
right.
I think you just said it there. You might have to sell it. So what we're looking at on the loan side is we break it into the 3 parts. I call it the credit, capacity, and then the collateral for the loan. So first things first, while you're establishing your equity and your position as far as your existing home, check your credit. Make sure your credit on the mortgage score is where you expect it to be. And if you still have some hangover bills from Christmas, pay them off before you check the credit for the official loan side of it. A thought comes to mind here. This is all just premeditated. So you're doing this before you find the house.
Yeah, and that's a good point. And I want to talk about this because right now there's not a lot of inventory. If you're thinking about doing this in 2022, now's the time to do all these steps. And particularly, you need to be careful on, I've seen some of our clients, one of our joint clients recently closed all of our credit cards and paid off all of our debt. And
Sounds
then
like a dream.
That sounds like the right thing to do, but it's not, it turns out, because then you have no credit history. So that's another thing, is that you need to get in and talk to the professionals, have them review your credit report, have them tell you what to do rather than just assuming that less debt is better.
Yeah, this person paid off all their accounts.
Which is great, out of debt.
Yeah, and then 6 months later, the credit scoring models came back with no score at all, right as they were submitting for an offer to update the pre-approval. And it had been 6 months of 2021 with very limited inventory and not the right property or opportunity, and then we lost it.
Yeah, so talk to a professional about what you need to be doing. Don't just assume that you know what you're doing. And that's why he can help you out. He's one of the best in town. So, all right, so once you talk to Brian, we start talking about options. There's several options out there. We're going to give you the top 5 or 6. And then, of course, if you have more questions, you can always call us. We are always willing to go to lunch, or you can come in for a direct meeting. So the first option is, sell your existing home. So that puts you in the best position, obviously, because you're not contingent. The problem is A, where you're going to live. And there's different options. Brian and I kind of talked, you can rent. There's quite a few different apartments and organizations popping up in town that are offering that 60-day to 150-day rent. So that's out there. But just keep in mind that if you're doing that, you're probably going to pay more. Nothing is for free.
Well, and you've got to move twice.
Yep, you got to move twice. So that's kind of a hang-up. Some people have RVs, right?
It's awfully cold. I think it was 19 degrees, Ken, when I drove to work this morning.
Yeah, so you got to, but some people can do it. I know some people that you're like, oh, you're going to do that. And then
we're planning ahead, so maybe this will be the springtime.
Right,
You can go RV park to RV park for your summer vacation.
And some people have that option. Not a lot of people do. The other thing, you can live with family. I know that for a fact, like my mom moved. She sold her house and then moved in with some family. I mean, that can test people's relationships.
That'll motivate you to get the next one.
That's right. It'll motivate you. But just keep in mind that, it's still a seller's market. So you may not find your perfect house right away. But I'm just telling you, that is, if in a perfect world, if you can do that and have the money and then you're non-contingent, that's the best way to go.
I mean, really, that just gives you the most down from the equity on your existing home. So this is assuming you don't have other funds. If you have other accounts, like,
and I did skip over that. I looked at it. So the other thing is, you can afford both. Can you afford both? And that's, again, when you have to talk to Brian and make sure that you can afford your existing home and then the new home. Then what you do is, it's a little more risky, I'm just telling you, is because if the market kind of goes down because of interest rates,
you got to carry 2 notes.
You got to carry 2 notes, and then there's inherent risk, and we don't want to put people in inherent risk. But some people have the means to come in and afford both. So what they'll do is they'll buy the new one, move their stuff, and then we'll put their house for sale. But there's risk with that, because if the market drops, then you could be stuck with a home that.
Well, and right now the market's moving really quickly, so it's pretty liquid to sell your property.
But that can change. I mean, we're seeing interest rates go up, and we have the Fed saying he's going to raise rates 0.25% 4 times. So
today, I think he's supposed to talk about that.
Yeah, so keep an eye on that. That's the big thing that a lot of people aren't talking about. So now, if you can't do both and you don't want to live with your in-laws, the next step people ask are, all right, what are my other options here? So the first option is a contingent sale. Now, I can tell you we do them all the time, but they're not for the faint-hearted, just because now what's happening is there's so many other parties and moving parts that we have to deal with.
Well, you got 2 levels of that, right? Like, you got contingency, like, I'm going to make you an offer, I'll buy your house, but you got to wait for me to find a buyer for my house. Or you preemptively sold your house and you have a buyer, now you're going to go look for a house. And I think that probably makes it a stronger contingent offer, but this is assuming you're going to find the perfect house after you've already found a buyer for yours. And then you've got to figure out, is that buyer contingent on selling their house?
And that's something we'll make sure that we coach you through. Obviously, we don't want triple contingencies because then everything goes haywire.
It's domino.
Yeah, so the other thing you can do, so in that scenario, what you need to do is, have your house, get it ready, hire a real estate professional come in, give you recommendations, have your house ready to go, have pictures taken, have the listing agreement, and then start shopping around. And then you have to find a seller out there, which it does happen. There are sellers, and if you're buying a high enough in home, that they'll say, yeah, we'll do that, and we'll give you 30 days to get the contract.
Do you think they care if you give them their asking price, or are you going to be able to cut them at their knees?
Yeah, so that's a very good point. It does limit your ability to negotiate.
I would think.
So, but it can happen. The other thing that we're seeing too is we actually get into contracts. So we do a contingent offer saying a buyer coming in is contingent upon us finding a home in the next 30 days.
Okay.
And then what we do is we structure it, say, all right, you're going to give us 30 days, you're going to go into contract, buy our home, and then you're going to give us 30 days to get in a contract on our future home. And we've done quite a few of those, but just keep in mind that there's going to be fewer buyers that can afford to do that, right? Because the buyer's going to want to buy your house. But there are people out there that, in some circumstance, and it happens a lot with California buyers, is they don't need the house for 6 months. And they're just happy to get into a nice house.
Lock it in.
Lock it in, and then 30 days. And now after 30 days, if you're not in that house, you can either extend or the escrow falls through and you do it again. So,
not for the faint of heart.
No, it's not, because there's just a lot of moving parts, but it can be done. And we did several last year. So if you don't want to do that route, there's products out there called bridge loans. Now, bridge loans have their own set of issues. So Brian, tell us about bridge loans and how they work.
Yeah, so I like to break it up into the two parts for bridge loans. So the first one would be like the whole plan. I think the whole point of this is to plan ahead, right? So if you're being proactive and you're thinking about selling your house in 2022, get a home equity line of credit instead of a bridge loan. And I'll define the difference between the two.
Yeah, I'd like to know the difference because there are a lot of questions out there.
Well, so you can get, like, if you have $400,000 in equity and you could get $200,000 on a line of credit, so you're not 100% of your equity from an appraisal, but you've got half of it accessible. You could qualify for a new loan, and we would present to underwriting that you're going to keep your current home with your first mortgage, and now we're going to add this $200,000 loan in this example, whatever that payment looks like from your note or your agreement with the bank, and then you've got to be able to qualify to carry those two notes plus your new note on the house that you're buying with your $200,000 down. After you move into the new house, you could sell the house. It would pay off this first mortgage and the second mortgage. There's usually a very minimal cost to pay off a home equity line early. I think the bank I use is $250. So not a huge cost to take advantage of this, but it was a premeditated act. You had to do this ahead of time. Once you list your house for sale or once you're in contract to buy another house, it's going to be hard to get a home equity line on a house that you're about to leave because the bank doesn't.
So what does it take to qualify for a home line equity? What is that? Is it 60 days? What is that scenario? You come in, you file an application.
We're doing them in 3 weeks.
Okay, so it's not quite as much as
They're going to appraise the house, and they're probably going to appraise it for less than your agent would be able to sell it for, or at least the projected sales price. That whole pre-planning meeting with your realtor ahead of time and valuing your home, you might get an appraisal for 5% less than that. But you're not trying to tap into 100%. You're just leveraging a percentage, a loan to value of your existing, what this appraisal would look like compared to your first mortgage and what the maximum second mortgage allowed. So typically, you don't want to go over 90% in your total loan to value. If you can stay below 80% loan to value of appraisal, you're going to get better rates.
Okay.
My client's doing this right now. I think it was 1.99% rate for 6 months. Well, they're not going to pay this thing they're not planning, I should say, to pay this for 6 months because they're planning on paying it for like a month or less. When they move into the new house, they're going to sell their home and hopefully find a great buyer that's not, that could give them the best price. So if you can afford all 3 notes, that's the home equity line route. The bridge loan or traditional bridge loan, you actually have to list your house for sale before you can apply for the bridge loan.
Okay, I did not know that. So you have to actually physically list your house and then apply.
Costly.
Yeah, what are we talking about cost?
I mean, we're talking about like, okay, this is a bridge loan, so this is a second mortgage. It's not as big of a dollar amount, but you're talking about multiple points. So maybe 2% of whatever that loan amount looks like. So in the $200,000 home equity line example, let's just say the bridge loan is $200,000. You've got $4,000 roughly in fees associated to that, plus an interest rate that you'd be paying on that. I guarantee
higher?
It would be a lot. If you could get the 1.99% HELOC rate as like a starter rate and only pay that for 6 months, you're looking at 3 times that most likely for a bridge loan. But again, you're only paying it for a short period of time. It might not be a lot of interest unless you can't sell your house, right? If something happens to the house and you're still paying on it, you have a time frame or a limit. You have to pay it off in 6 months.
Okay, so that's another good point is make sure you can actually afford to do this. I mean, a lot of people in 2007 and 8 were doing this kind of stuff and got caught with their pants down. So, and Brian and I have been in the business long enough, we saw firsthand the destruction. So we don't want you to do that unless you can truly afford it.
The lending industry doesn't want you to foreclose. So
right.
the whole goal here is to set it up where you're going to win, the bank's going to win, you're going to borrow some money, pay a little bit of interest, but pay the bank back, right? So we're just figuring out and mapping that out ahead of time. And so the home equity line, more premeditated than a bridge loan. Bridge loans will be more costly in fees, but if you're doing this last minute, like you already found the house that you really want to buy, and then you want to apply for the loan after you've already...
So how long does it take, so you get into contract, and then how long does it take to find out you can do a bridge loan? Because, and who's gonna, what kind of seller...
So you're gonna do an appraisal. Just like
what kind of seller though is gonna allow that? I mean, if you're not already have the ability, I mean, if I'm representing a seller, am I going to allow that? I mean, that's the question, I guess.
I don't know. Do you verify all the funds for your buyer?
Yes.
Okay. With how?
I call the lender and I want bank statements and I want.
So the lender better be prepared to help you present your offer. I think that's probably the key thing. Is. So if you're doing it last minute, the lender's going to be less prepared than if you had this all pre-planned out as part of your pre-approval weeks before you actually found the home that you want to submit an offer on.
So the bottom line is, if you're thinking about doing this, you got to get your ducks in a row. You can't. I mean, we have people come in the last second.
You can do it. It's going to be more stressful.
It's going to be a lot stressful. Just get it done now. And when the inventory is tight, and you still have 2 or 3 more months until the inventory ramps back up. So get it done now. So we're moving on here. We already talked about contingent sale. The other option, and I have people doing this right now, are you bought a house for $140,000 in Northwest Reno. It's 1,100 square feet. You're fortunate enough to buy 7 or 8 years ago, so you have a nice pocket of equity. Make it a rental.
That's a great way to do it.
And now, how does that work with qualifying? Can they, if I come to you and say, hey, they're going to make this a rental, do they, until I have a lease in place, can I count that income, or how does that? If there's a buyer out there, can they use that income, or does it have to be a signed lease, or what's?
I said earlier, credit, capacity, and collateral. So now you've got 2 pieces of collateral. You've got the house that you're going to turn into a rental, and it can bring in an income. So we can use estimated rent on the departing residence, but you have to fulfill a lease agreement in order to make it work for closing your loan. If you have to have that additional income to qualify, we will count a percentage of it. It has to be verified with a third party. So there's websites, there's automated valuation systems to figure out what rent might go for. But ultimately, you have to plan ahead and see what that rent would look like. Also, now you have to figure out where your down payment's coming from for the new house. So if you're still, with $140,000 house in Northwest Reno 8 years ago is worth how much today?
$450.
Okay, $450. So it's gone up 3 times. Call it triple.
Yep.
So are you going to take a home equity line of credit, which that inherently is an adjustable rate second loan?
Do that if you're going to make it a rental.
If you're going to make it a rental, so would you need to refinance? Now, if you refinance that home that you're going to turn into a rental, you can't say it's your primary residence, even though today it's your primary residence. It's about to be a non.
Yep. So be careful that you don't want to.
Well, you could disqualify your next loan. So basically, I've had folks refinance the house and they had planned to stay there, and then now all of a sudden they changed their mind and they wanted to go buy. Maybe it wasn't premeditated. They didn't plan ahead. The perfect opportunity came up. Well, they had to really explain what changed in their household to make it possible for them to basically do 2 primary residence loans in a 6 month window. Because
now, if you're past 12 months, right, it's usually typically okay.
Oh,
so,
yeah.
so if you're thinking about doing this long term, what you might want to do now is take advantage of the good rates. They're still 4 or under.
Absolutely.
Get the money out, sit for a year, and then it really puts you in a nice position moving forward.
Or maybe it takes that long for a new home builder to build your house.
Good point.
It's another option.
So a rental, but keep in mind, we're going to need to have a discussion about rentals because they're not. We own some, and man, it's been a tough couple months for us between repairs and bad tenants and leaks. You have to really set that up, and we can help you with that and give you some advice and set you up with the professionals. Like, gotta get an LLC, gotta get a property manager. So there's.
Sounds more planning, right, Ken?
Yeah, more planning. That's what we're all about here on this channel. So just kind of putting it out there, but it can be done.
Okay, so convert it to a rental property, and we can use future rents to help qualify.
And keep in mind that I have clients right now that have planned and they did this, and I just estimated what their rent's going to be. They're going to make $1,200 a month.
I've had clients that do this every 3 years. They come to me and say, "Hey, that house that you helped me with 2 or 3 years ago, I want to go buy another one. I'm going to turn that one to a rental." And then after 10 years, they've got
nice
3 or 4
flow.
property and a bunch of cash flow because they bought them all and they've all been appreciating.
Right. So it's a good option. Yeah, you gotta know what you're doing, and obviously, I stress to you that you need to have your team, and I talk about that a lot in this channel. You got to have your loan professional, your realtor, your attorney, your CPA. Everyone needs to be on board. Don't be once you get rentals. People are still trying to do their own taxes. I'm just telling you that.
It's just fraught with potential issues.
Yeah, just make sure you have a licensed professional on the CPA side or a real agent helping you out on that. So, moving on, we got the contingent sale. Now, I want you to quickly talk about recasting.
Yeah,
that's a new thing, and the thing that I'm confused about, and a lot of my viewers, I would say, are too, is it automatically when you shop for a lender, do you have to ask if the mortgage has a recasting option? Is that a question I need to ask a lender like you?
Absolutely know ahead of time.
Are there products out there where you can't recast?
Correct. There are lenders that don't allow it. There are some that charge fees. It depends on the type of loan you're qualifying for. So let's say a jumbo loan, which is say $650,000 plus loan. There are dozens of investors, and some of them allow recasting, some of them don't, some of them have a fee, some of them don't.
Let's talk about what is recasting though.
So recasting would be a great, just to kind of take us back to the home equity line of credit example. You had $400,000 in equity, but you took $200,000 on a line of credit, so you put $200,000 down
to get 20%.
And when you sold your house, and so now you have the rest of the other $200,000 in equity that was still sitting in the home. So what do you do with it? Well, you could put in a really nice backyard in your new house, or you could pay down your mortgage. So your loan started off as, we'll say, a 30-year fixed loan with $200,000 down. Now you want to put $200,000 additional to it. Well, recasting re-amortizes. So if you're 6 months into your 30-year loan, you're recasting, so you're maintaining a 35.5-year remaining term at $200,000 less than principal. So your payment goes down.
So it doesn't reduce the amount you're doing or the time frame, but it reduces your principal balance.
Correct.
And then it resets your monthly payment down lower.
It re-amortizes the payment as if you put that $200,000 in at the very beginning.
So it's almost like a inexpensive refinance,
free.
Right?
With us, it's free.
All right. So with Guild, it's free. I know that other lenders charge a minimal fee in there, but you need to ask about this when you're calling and interviewing lenders. And find out if it's an option, because some lenders don't have it, or some lenders charge.
Well, step 2 was find the neighborhood, right? So you've got a price range of what you want to look for. So if you're going to look for $1 million house and you're only going to be able to put $200,000 down, you're looking for an $800,000 loan. So that would be specifically a jumbo loan where you very much have to know exactly what product you're best suited for. And really what we're doing to just avoid the issues altogether is just take the loan application, take the credit report, all the information, and get an underwriter to sign off on it. So now you're not only just pre-approved with the loan officer on a pre-approval is basically making a decision. You can get an underwriter's decision, so you can come in the door with your offer to say, look, Mr. Seller, I've actually got a fully approved loan. All I have to do is close, right? Based on whatever time frame you can negotiate, and that fits for both sides.
And I kind of want to talk about this too, because a lot of people are using out-of-state lenders or ABC Bank from
.com something.
I'm telling you, in this market, if you're not using a local professional like Brian, well known in the community, I'm telling you, last year we win contracts and get people into houses because they know that Brian and his team have already pre-approved and know that for certain it's going to go through. So there's something to be said for using a local lender.
Well, the seller too.
That's what I'm saying is that the seller and their agent know Brian or know one of our preferred lenders, and so it's a huge thing that people overlook. So make sure that you're choosing a well-known mortgage person like Brian. It goes a long ways, and all these things. Maybe one thing by itself won't add up, but once you have all the things, you put in a good contract, you have a good realtor, all these things add up. You have a local lender to getting offers.
So this sounds like it could be complicated. Is that fair?
No, it's not complicated. No, it is. No, I'm serious. It is complicated, but you need to know.
Well, so I guess my point in bringing that up is like kind of kicks us to the last option is, wow, this might just be too much to deal with right now. Maybe it's best to just stay put and remodel the house and make it the house that you always wanted it to be.
Yep.
To not have to go through second mortgages and all this kind of mess.
Yeah, and that's a good point. Is to kind of wrap this up. This isn't for everyone, and you're not going to hurt our feelings if you decide to stay in your house and remodel, or maybe refinance, take some money out, and just maybe stay in that house, and then you don't have to worry about a big house selling it in 10 years when your kids move out.
Well, then because then you're going to be a moved down buyer.
Yeah, then we're going to be an empty nester, which we're going to talk about maybe in a week or so. We want to talk to you about, you're at that point, you've owned your house for 40 years, your kids are gone, want to move down. So that's another option. So
maybe you could buy two at that point.
Maybe. So I think the biggest thing in here is hire professionals. You got to have your whole team. You got to have a good lender, got to have a good agent, got to have a good CPA and a lawyer if you're going to do this, to be real about it. And Brian and I know all the different people in this industry, and we sign you up with some of the best people that we work with. So, any last comments?
Well, we touched on interest rates have gone up. I mean, from a lot of
keep an eye on that.
Well, the projections I heard with rates would be 4% by the end of 2022, and they've gotten really close in just 3 or 4 weeks. So the Federal Reserve is going to make announcements. They're going to make moves. There's also geopolitical, international.
That's a good point.
Issues that are
driving
bubbling over right now, and the stock market has been pretty volatile. I think that would remain. So just if your stock market balance, like if your 401k statement came out this month and you had X amount of dollars in there, and then you logged in this afternoon and realized that it dropped in value, well, don't freak out. It's your retirement account. But that's the same kind of volatility we're seeing in interest rates. So the reverse happened on mortgage rates. They went from really low, they went up. Are they high? No.
Not relatively. If you looked at the last 4 years.
Are you going to get the 50-year low? No. Could you refinance if the 50-year low came back around in 2 years? Of course. So make the move that's right for you, and then in the future, you have a 30-year fixed mortgage. We don't do many adjustable rate loans, so that's not even a concern. So you're going to have a fixed rate loan. So worst case scenario, in the future, your value improves, and your rate goes down if you're able to refinance, or maybe you remodel the house that you just bought.
Yeah, I think the bottom line is make sure you can afford the new payment. That's the bottom line. Is don't get into something you can't afford. We don't ever condone that or recommend that. We want you to be able. We don't want to ever short sell your house. So make sure you can afford it. So thanks for coming in.
Absolutely.
I think we're going to interview Brian about empty nesters. So if you want to know more about that topic, you're going to have to subscribe to our channels. Give us likes. Comments are appreciated. Any other topics that you want to know about, put them in the comments below wherever you see these videos. And we appreciate you guys tuning back in. So until next time, you guys take care. Take it easy, Brian.